Hello and welcome to this session of our course on Financial Institutions and Market. I am Dr. Sonam Badhoria, Assistant Professor at Swami Rama Himalayan University. In today's lecture, we will turn our attention to a unique financial instrument that blends features of both equity and debt. This is the preference shares. Whether you are a finance student or corporate decision maker, or an investor looking to diversify your portfolio, understanding preference shares is essential for you. They offer a hybrid capital raising option for companies and an income-oriented investment opportunity for individuals. In this session, we will explore what preference shares are, their defining characteristics, the various types of preference shares, how they differ from equity shares, and their overall importance to companies and investors alike. So let's begin with the basic questions. What are the preference shares? Preference shares or preferred stock represent a class of ownership in a company. However, unlike equity shares, preference shares come with preferential rights in two key areas: payment of dividends and repayment of capital during liquidation. This means that the preference shareholders are entitled to receive dividends before equity shareholders, and in the event of the company winding up, they have a higher claim over assets than equity holders, although they rank below creditors. One of the most notable features that preference shares have is they receive a fixed dividend, similar to the interest earned on a loan. However, they generally do not have voting rights unless the company fails to pay dividend for a specified number of years or proposes changes that directly affect their rights. Now, let's talk about why companies issue preference shares. From a company's perspective, preference shares are a valuable financing option. They allow companies to raise long-term capital without giving up control. As these shares usually come with limited or no voting rights, unlike debt instruments, preference shares do not increase the company's debt burden in terms of regular interest payments or strict repayment obligation. At the same time, they are less dilutive than equity shares in terms of ownership and governance. For investors, preference shares are attractive because they combine the fixed return of debt with the ownership element of equity. This makes them ideal for conservative investors seeking regular income without taking on the full risk of the equity investments. Now, talk about the key feature of preference shares. So, the first, as mentioned earlier also, they offer a fixed rate of dividend which must be paid before any dividend can be declared for equity shareholders. Second, the preference shareholders enjoy priority in dividend payment if the company declares a limited profit in a given year. It must fulfill its obligation to preference shareholders before considering the equity dividends. Third, they have preferential treatment in capital repayment also. If the company is liquidated, preference shareholders are repaid after creditors but before equity shareholders. Fourth, the voting rights are generally absent for preference shareholders. They may gain voting rights only under special circumstances, such as non-payment of dividends for 2 consecutive years or if their rights are being altered. And finally, preference shares are considered a hybrid security. They carry traits of both equity ownership and debt ownership. They balance the risk and reward also. Now, let's explore the different types of preference shares. Those are available in Indian financial system. based on their specific characteristics. The first classification of preference share is cumulative and non-cumulative. The cumulative preference shares allow for the accumulation of unpaid dividends. So, if a company cannot pay dividends in a given year, the missed amount is carried forward and paid in the future when profits allow. In contrast, non-cumulative preference shares do not carry forward unpaid dividends. If the dividend is not paid in any year, it is simply forfeited. Second, we have participating versus non-participating preference shares. The participating preference shareholders receive their fixed dividend and may also participate in surplus profits alongside equity shareholders, provided the company has held exceptional year. Non-participating shareholders, on the other hand, are entitled only to the fixed deposit. Next type is the convertible versus non-convertible preference shares. The convertible preference shares can be converted into equity shares after a specific period or upon the fulfillment of certain conditions. This provides an opportunity for investors to benefit from capital appreciation in the future. Non-convertible preference shares, however, remain in their original form until redemption. Then we have redeemable versus irredeemable preference shares. The redeemable shares are issued with a specified maturity period, after which the company redeems them by paying back the capital to the investor. Irredeemable shares, which were once used, are no longer allowed in India under the Companies Act 2013. All preference shares now must be redeemable, typically within 20 years. Now, let's take a moment to compare preference shares with equity shares to highlight how these instruments differ in nature, risk and rewards. So, the preference shares offer a fixed dividend, while the equity shares provide variable returns based on company profits. Preference shareholders enjoy priority in both dividend payments and capital repayment during liquidation, whereas equity shareholders receive returns only after all other obligations are met. On the risk spectrum, preference shares are considered less risky than equity since they guarantee a fixed return and have a higher claim on assets. However, this safety comes to a cost. Preference shares typically do not carry voting rights, while equity shareholders have full voting privileges in corporate decisions. In terms of return potential, equity shareholders benefit from unlimited upside through capital appreciation and surplus profit distribution, while preference shareholders have a capped return limited to their fixed dividend rate. Overall, preference shares are ideal for investors who seek a balance between risk and return, offering more stability than equity, but slightly more risk than debt instruments. Let's look at the simple example to understand how preference shares work. Suppose you invest in 100 cumulative preference shares of a company, each with a face value of Rs 100 and a fixed dividend of 10%. In the first year, the company earned insufficient profits and does not declare any dividends. However, since these are cumulative shares, your entitlement is not lost. The unpaid Rs 1000 gets carried forward in the second year. The company earns high profits and declares dividends. You now receive Rs 2000, Rs 1000 for the current year and Rs 1000 for the previous unpaid year. This ensures a more stable income stream, especially for long-term investors. Now, let's look at the regulatory framework of preference shares in India. The issuance and redemption of preference shares are governed by the Companies Act 2013. As per the law, all preference shares must be redeemable within 20 years from the date of issue, except for infrastructure projects where the limit may be extended to 30 years. The Act also lays down rules on dividend rates, redemption procedures, and investors' rights. Additionally, SEBI guidelines apply when preference shares are listed or offered to the public, ensuring proper disclosure and investor protection. Some companies also list their preference shares on stock exchanges through trading volume are often lower compared to the equity shares. Now, to summarize the session, preference shares are hybrid financial instrument combining the features of equity and debt. They offer fixed dividends, limited or no voting rights, and a preferential claim over profits and capital. For companies, they are a flexible means of raising capital without diluting control. For investors, they offer relatively secure income with moderate risk exposure. As we conclude this session, I leave you with a few reflection points. Why might a company choose to issue preference shares instead of equity or debt? Think, what are the potential risks and rewards of investing in cumulative or convertible preference shares? And also think, how can investors use preference shares as part of diversified investment strategy? Thank you for joining me in this lecture on preference shares. In our next session, we will explore debentures, another vital component of the financial system. Until then, stay curious, stay informed, and keep building your understanding of financial world. Thank you. Namaste.